Good afternoon and welcome to Reinhart Berner's discussion of the new tax law, often known as the Tax Cuts and Jobs Act. I'm Michael Goller. We have here today, and I'll go down to my far right, John Schliessman, Amy Barnes, then Lucian Baudre, Ben Gensler, and Rob Meisey. Our time is short, so why don't we jump right in? I'll say at the onset that there's a lot of unknowns in this law. We're going to have to wait for some guidance from the service. But let's jump right in. We'll start with a few housekeeping items. We'll automatically advance the slides. Handouts are printable, and you can see the slide here. So let's jump right in. First, let's talk about individual taxes, if we could. A lot has been said about the change in the tax rates. Virtually everybody benefits from the reduced tax rates. I'll point out there's maybe, I don't know if this is a blip or not, but if you're unlucky enough to be at income from $400,000 to $416,700, the rate on those dollars actually goes up, you can see there. It's at 35%. Previously, it was at 33%. But for the most part, I think the change in tax rates is beneficial to most individuals. Capital gains, the top rate for long-term capital gains and qualified dividends remains at 20%, 23.8% with the net investment income tax. Let's talk a little bit, group, about the standard deduction. A lot has been written about this. Obviously, it's increased to $24,000 for married filed jointly. That almost doubles the standard deduction. It's indexed for inflation, and I've seen estimates that say north of 85% of all taxpayers will now not itemize. They'll claim the standard deduction because of the phase out of miscellaneous itemized.
Yeah, Michael, I wanted to add this. I've been someone who's itemized forever. I don't remember, using the standard deduction, but now I anticipate I'll be part of the 85%. And one of the things, I found a little nugget that apparently prior to this, there was an additional standard deduction for people age 65 and greater and people who are blind. And for those of us in that group or who will be in that group, if you're married and you and your spouse are over 65, it's not 24,000, but 26.6. So there's a little extra benefit that I didn't anticipate.
I didn't anticipate that either. That's a great point. Let's talk a little bit about the personal exemption and child care. Personal exemptions are suspended until 2026, so they're not gone forever, but they're out for now. The child tax credit is made easier. It's more, and that somewhat mitigates this, because if you have a large family where you lose the personal exemptions, you're going to be more likely the credit has been increased slightly, and it's also available to more taxpayers at higher adjusted gross income levels. So that may mitigate that a little bit. I'm going to keep going through this quickly because we have a lot to cover, but this is now one that I'm sure the group will want to weigh in on. Itemized deductions, state and local tax deductions. Basically, most miscellaneous itemized deductions are gone. You can deduct state and local taxes up to no more than $10,000 per year. And if you're in a high tax state, obviously that's very troubling for you. Even if we're in Wisconsin here, which is maybe not a high tax state, but it ain't low. So that's a significant change.
Michael, I wanted to comment on this. Three of the high tax states are California, New Jersey, and New York. And even the Republicans there are just hopping mad about this. And so they're fighting this in a number of ways. One, they're trying to get the law changed in Congress, and I don't think that's going to happen, but they're trying. They're going to bring a lawsuit, if they haven't brought it already, in New York, claiming that the provision is a violation of state rights and equal protection clause. Perhaps the most interesting fight back is in California, where they're talking about changing the state tax law to provide that if you make I'm putting air quotes here, charitable contribution to the California Excellence Fund, you'll get a credit on your state's taxes equal to the amount of your contribution to the California Excellence Fund. And what they're attempting to do is convert the payment of state taxes to a charitable deduction. And they seem to be hopeful about this because there's a little something similar for $500 in Arizona that they're hanging their hat on that hasn't been challenged. But, the bottom line is that if you make any contribution, even a contribution to a 501c3 organization with the expectation of getting anything in return, and I would suspect that getting the credit on your state taxes is getting something in return. You don't get a charitable deduction. It'll be interesting to see how that plays out, but we'll be hearing a lot about that as time goes by.
And John, I was over at the IRS yesterday, and they were talking about that, chopping at the bit, saying, I was in Wisconsin IRS, but still, if that were to happen, you can see a lot of disputes coming down the road on that issue.
Yeah, a couple points to solution. My understanding is the $10,000 limit applies whether you're single or married. So again, a little incentive there not to get married or get divorced. Sometimes that's tax planning. The other thing is you wonder whether you're going to see more people trying to get maybe second homes on Schedule E, start renting them and things like that, because if you can report the property taxes on Schedule E, perhaps you can deduct those.
Let's talk a little bit about home mortgage interest. That deduction is still around, and going forward, it will be on acquisition indebtedness of up to $750,000. So, quite frankly, if you have a large mortgage and large mortgage interest, that, along with your state taxes and perhaps charitable contributions, might get you to a point where you want to itemize. But that's something that's around, that's out there.
Mike, one point on that. In planning when you buy a house, it's interesting because there's going to be a little bit more difficulty in the calculus. Oftentimes you may say, well, I don't want a big mortgage, but it might make sense from a tax perspective to get the maximum amount of initial mortgage you can, now that we don't have home equity loans as deductible. And so if you put in more of your own cash as a down payment versus maximizing the mortgage, you can possibly end up in a worse tax situation. So now, even just buying your principal residence, you got to think about, does this make sense, especially in light of the much higher standard deduction?
Right. And to your point, Lucian, the new law does suspend the deduction for interest on home equity indebtedness. So that's a change which, quite frankly, caught a lot out of left field. Charitable giving. I mentioned earlier, this is still, if you itemize the deduction that you can take advantage of. Charitable giving, they've increased the income level before they phase out whether you can take a charitable deduction. So charitable giving is something that is out there where you may, that coupled with your other deductions that survive, may give you an incentive to itemize in certain years. At the bottom, the note that back before my daughter was born, I used to have Marquette tickets, and you would get better Marquette seats if you made a donation to the athletic department, and I know that's still the case. That is going away. If you're getting something in exchange for a donation, like good seats or the ability to buy tickets, that's not deductible anymore. So that's I've had a number of calls on that already from some of our partners, I might point out. This raises an issue of what we call getting lumpy. What does that mean? It doesn't mean eat extra dessert. It means you may want to lump your itemized deductions, the ones that are together, every other year. So maybe one year you take the standard deduction. The next year, because you lumped what you could in terms of itemized deductions into the latter year, you itemize that year and go back and forth. So it's a year-by-year basis whether you take the standard deduction or you itemize.
Yeah, the biggest planning strategy here is many of us, make annual charitable contributions, oftentimes to the same organizations, oftentimes in the same amount, or we slightly increase it on an annual basis. And a lot of charities plan based on that. And a lot of it's done through kind of corporate fundraising. For example, the United Way. A big strategy would be to set up your own donor advised fund and make a big contribution one year. And then through that donor advised fund, you can still bleed that money out over time and still make your annual gifts. I think you're going to oftentimes get a much bigger tax savings when you do that, especially in light of the higher standard deduction.
And Lucian, I was on a call this morning where somebody raised the issue. They pointed out after the '86 Tax Act, charitable giving actually went up. And the question was, will that happen here? And my response was, I don't think the charities are opening champagne bottles on this. But to your point about donor advised funds, there's a real incentive to consider that as a strategy.
I also want to point out, this is John speaking, that there's a limited ability to lump when it comes to taxes. That there's some provision in the law that really does not allow you to prepay state income taxes. And then you can prepay property taxes only if they're assessed. And you can't prepay a property tax which has not been assessed according to IRS guidance. So You have some limitations on your lumping strategy.
And some states are talking about changing the assessment process for that very purpose. The AMT, the individual AMT, I won't spend a lot of time on this other than to say more and more people will not be subject to the AMT. The exemption amount is increased and the income threshold is also increased. So this is good news, I think, welcome to many, that most people will not be subject to the alternative minimum tax at the individual level. Estate and gift tax, the unified credit is increased substantially. As of right now, index for inflation, it's 11.2 million, which means right now, if you have $22.4 million, you'll pay no tax and you really don't have to do much planning. Now, the devil's in the detail. This is all reverting back. We've got 8 years of this increased unified credit, and then if something doesn't happen, it all reverts back to 2017 levels, index for inflation. So really, we have a short period of time. I had somebody call me the other day for some planning, and their client was 103 years old. I took the position that person is probably okay from a planning standpoint over the next 8 years. These rules will apply, likely. On the other hand, if you're 70 or 80, odds are you very likely may be around after the end of this 8-year period, and you might want to consider some planning in the interim. And the bottom line point on the slide is gift appreciating property before 2026. And be aware for the fact that we will be back. The estate tax is not going away. This could be sort of similar. Remember when they started the estate tax for a while, and it got less and less and less. And remember 2012 when there was no estate tax? And Rob Mighty, who was lucky enough to die in 2012? You're a sports nut. Do you remember? George Steinbrenner. Yeah, close to $1 billion.
Right.
Tax free.
Michael, I want one point of clarification. The decline in number from 5,500 to 1,700, is that an annual figure?
That's the annual number of taxable estates, yes. Yeah, so you can see it's going to, then it's an estimated number, but it's estimated by the IRS to go down significantly. Be aware, though, there's some states have an estate or inheritance tax, so be aware that the states are not necessarily on board with all this, and be aware that that's out there as well. With respect to all these changes, be aware of the fact that the states will often not go along with this. And some of them, as you mentioned earlier, the high income tax states are not happy with this law at all. So they're not necessarily going to jump on board with this.
Yeah, and this is Lucian, and I do know that some of our current Wisconsin legislators are looking for feedback on how some of these rules might apply for Wisconsin purposes and what changes we might make to our system. So, stay tuned for what will happen in Wisconsin.
Stay tuned what will happen in Wisconsin. And also what's going to happen at the federal level, because as we said at the top of the hour, it's not that clear what's going on. We're going to need some guidance from the IRS. I heard this morning, I was talking to an accountant, I won't mention who it was, and she said, "You know this representative?" And she mentioned her local representative. And I said, "I know of that representative." And he said, "Well, could I come over to your house and talk about the new tax law?" So in other words, he wanted some education on the law that he just signed. So it's complicated. Education provisions, changes 529 plans, and I love 529 plans. My daughter's 13, and we've had a 529 plan since the law started, which was 16 years ago. If we didn't have kids, I was going to retire at age 60 and go take cooking classes in Europe. That dream is now dead. But 529 plans are still around, and they got better if you can use. Historically, they were only used to fund college. Now you can fund kindergarten through 12th grade up to $10,000 a year with funds from a 529 plan. Also, if the student dies, it will not be, if the debt is forgiven, that's not taxable income. IRA rollovers, the Roth Conversion rollover concept is still in play. What that is if your income is so high that you don't qualify to contribute to a Roth IRA, what you do is you contribute with after-tax dollars to a regular IRA and then immediately roll it over to a Roth. And that's a means of funding a Roth even though your income is over a certain level. What you could do, and you could still do it for 2017, is once the money is in the Roth, wait and see what happens in the stock market till October 15th, the extended due date of your tax return. And then if you want to reverse it, if the market went down, you could do that. That second part, the reversing of it, is out after 2017. But you could still do the first strategy that I mentioned. Alimony. This was often watched. There used to be what I would call a fun planning technique, where if husband and wife are unfortunately getting divorced, one spouse is going to be a high income spouse, the other spouse is going to be a lower income spouse. You play with the alimony so that the higher income spouse could get the deduction for it, and the lower income spouse would pick it up as income, and the only person who got the short end of the stick was the IRS. Now that planning is gone. Alimony is not deducted by the payor, and it's not included in income by the recipient.
Yeah, and again, I think this probably after 2019 is not going to change alimony. I mean, I think it'll still be out there, but the amounts may change because you'll have to tax affect it.
Right.
After, if you're paying it, you don't get a deduction, then presumably you'll pay less, you know. I guess that's subject to negotiation.
But I was talking to a family law attorney last Friday, and he was saying, boy, they took all the fun out of it, and they sort of did. Let's talk a little bit about the business plan. I think, John, you were going to talk about this.
Yes, the absolute, at least in my humble point of view, centerpiece of the tax law is the reduction in the corporate income tax rate from what for large enough taxpayers is 35% to a flat rate of 21%. And unlike the individual rate changes, this reduction is permanent. Now, permanent in the sense that until America decides that the party in power is not working for it and decides to vote for the other party. Because I would suspect that if that occurs, and history demonstrates that it will occur at some point, that this will not be permanent, that will probably be changed when that decision is made by the American citizens. So I think that's important to keep in mind, because there's going to be a lot of discussion about the choice of entity. And there's some favorable changes to flow through entities, but this significant reduction in corporate tax rates going to make people rethink how they deal with the choice of entity decisions. And ultimately, I think a lot of people's first reaction is to become C corporations, but bearing in mind the point about permanency, you really need to balance the value of the lower rate, but the double taxation on distributions, including, taxation if the business is ultimately sold, with flow-throughs where there is going to be a higher rate, but you can make essentially distributions without any current income tax consequences. So that's going to be an interesting sort of exercise that we're all going to have to go through as clients, make this decision. We'll talk a little bit about the flow-through benefits later on, but when you think about some of the scenarios where you have to be thinking about what entity do we choose, you have to take a number of factors into account. What type of business are we? Do we get the benefit from the 20% deduction available to flow-throughs? What's the tax rate going to be? Are we planning on distributions, and when? Is it likely the business is going to be sold? Is it going to be sold at a gain? Will the buyer want to buy assets? There's both tax reasons and non-tax reasons that the buyer is going to prefer an asset deal versus a stock deal. Is it a situation where you may solve part of the issue by using the concept of personal goodwill? Does Section 1202 apply? That's a section that allows you to sell stock in a small business investment without any gain at the individual level. And so the point is, there's a lot that goes into this decision about choice of entity, and I don't think the answer is necessarily going to be, obvious. Some of the scenarios that may favor the C corporation are businesses that are likely to stay in a particular family for a very, very, very long term, where there's not likely to be many distributions, where if there's a basis step up, it's the result of stock passing as a result of death. Situations where you can qualify for 1202 and ultimately sell the stock, if you can sell stock without any taxable income, subject to complying with all the 1202 rules, the subject of which is a whole topic beyond this seminar. And then, with startup businesses, I think there may be some motivation to adopt C corporation status, particularly not only because of 1202, but also the ability perhaps to take a 1244 ordinary income loss if the startup business fails. But the scenarios in favoring pass-through entities, in my mind, are where there's potentially a business sale and the likelihood of double taxation, and any kind of business where you expect distributions. And so we've been looking at some software to help model out these alternatives, and we're still studying that. We haven't identified the one that's going to work the best yet, but it's going to be a very interesting exercise as we go along about choice of entity. And I know some of you have comments on that.
Yeah, this is Lucian. Just a couple points. I know a number of people have been coming to us and going to their accounting firms and saying, boy, should I get rid of my S corporation election? Should I become a C corporation? The rate is a lot lower now. And as John mentioned, not only do you need to sort of run the numbers of how much tax you're going to pay under each, but you really need to, look at all, maybe it's 20 plus factors and the differences that can occur as a result of making that change. In my view, it's really kind of a 10-year decision if you do it. You cannot re-elect for 5 years after you switch to a C corporation, and then for another 5 years on the federal level, you're going to be subject to the built-in gains tax. And sometimes the way those S corporation rules, if you want to re-elect, you might be prohibited by one of the distinct taxes, such as built-in gains tax or LIFO recapture. So be very, very careful before you blow your S election thinking you're going to get a big rate benefit. Make sure you understand it. I know that in the past we've had clients when rate changes that they've blown their S election intentionally, and oftentimes they were in the family context, as John mentioned, and they came to regret it years later when things changed, where they needed to do redemptions, where they needed to take cash out of the business, where rates weren't what they originally were when they did the planning. So I think it looks like low-hanging fruit, but you really have to give a lot of thought before you do that.
Yeah, I totally agree with that. But even in the family situation, because businesses evolve, family situations evolve, and you may find yourself in a position where you have to sell a business, and all of a sudden you're faced with double tax, and you're going to, your accountant and your lawyer saying, why the heck did we ever, do this? So I would be very cautious and not just rush into this.
Although let me say this, and amongst your many factors you do need to consider, I know we're going to talk about international later on in the program, but it seems to me that everything in the Act internationally favors C Corps also, so don't forget any international activity.
Okay, other changes in the corporate area are bonus depreciation. You get 100% first-year deduction for qualified new and used property investments. That phases out after 2022. After 2022, you may look at 179, which allows first-year depreciation. That increased up to $1 million. The corporate AMT has been repealed. If you have AMT credits, you can get some offset against your future regular tax liability, and those are partially refundable. There is a new limitation on net business interest to the extent it exceeds 30% of your adjusted taxable income. So that's taxable income, and you get to add back depreciation and some amortization and some interest expense. So you need to look at that if you are a highly leveraged business or you just don't make that much money. There's an exception for small businesses, namely those with less than 25 million of revenue. And if you have some of your interest expense disallowed under this rule, you can carry it forward. There's changes in the areas of net operating losses. You can't carry new losses back anymore. And your deduction going forward is limited to 80% of your taxable income in the year. So you don't lose the NOL, you just have to spread it out over a little bit longer period of time.
And John, if I could comment on the NOL, I find it interesting that they made this change because a number of times over my career, the last time was 2009, where when the economy gets sluggish, what did they do in 2009? They increased the NOL carryback from 2 years to 5 years as a way of stimulating the economy, because people who pay tax in 2004 forward would then file refund claims and spend the money. Now that the economy is going forward pretty well, there's no carryback whatsoever. But I wonder what happens next time the economy sputters a little bit. Does the NOL carryback come back?
Yeah, I'm not surprised they got rid of the carryback. If they're allowing all these additional depreciation deductions, if those create NOLs, they're not going to want people to go back and recapture taxable income because they got a larger depreciation deduction. Also, if your client is involved or you are involved in a settlement or a payout relating to a claim of sexual harassment, you do not get a deduction from this point forward if there is a non-disclosure agreement. Again, at the state level, various states are trying to outlaw non-disclosure agreements just as a matter of state law, and they're also looking in some cases to prohibit arbitration, which is a more private way to resolve differences.
And John, our labor and employment people are begging for guidance on this provision because their standard settlement agreements often waive all claims, every claim, even if there wasn't a sexual harassment claim, there's a waiver provision in there. And the concern is, does that somehow, just because that's in there, a release on that issue, make it non-deductible?
Yeah, and I just harken back as old tax lawyer to sort of the origin of the claim rule, where just because you're waiving it, unless there's been some allegation or some facts, I wouldn't necessarily think if you have some sort of a broad waiver, you have to worry about this unless there's something to support that claim.
Yeah, John, I want to mention something we briefly touched on that I think is going to change the landscape pretty dramatically in the deal context of buying and selling businesses, and that is the 100% bonus depreciation on used equipment. In transactions treated as asset sales or actual asset sales, there's oftentimes a negotiation between the buyer and seller on allocating the purchase price between equipment, which you used to be able to write off over maybe 5 or 7 years, versus goodwill, which is a 15-year straight line. And now, if you're a buyer, you can probably write off that equipment 100% in the year that you buy it. Now, the seller's going to have ordinary income, but buyers may be willing in some cases to gross them up a little bit to cover some of that ordinary income. So you might see more allocations to equipment in transactions.
Yeah, I agree with that, although I think you need to be careful, because if you're getting financing and using that equipment as collateral and the bank is asking for an appraisal of those assets, you probably need to make sure you have some consistency between the appraisal and the position you're taking. But bear in mind, there's different kinds of appraisals you can get. You can get an ordinary liquidation appraisal, but you can get an ongoing concern appraisal as well. And I would make sure you don't trip over the differential as you're trying to square up your appraisal and your allocation. Okay, let's move on. Now, we talked earlier about this new 20% qualified business deduction applicable to Schedule C, sole proprietors and pass-through businesses, and this is from income conducted in the United States. If you have there's a lot that hasn't been fleshed out here. So I would imagine that if you're a business that conducts business in the U.S. and business outside the U.S., you're going to have to make some sort of an allocation to determine, what the 20% applies to. But assuming you're dealing with an entire U.S. business, you get 20%, and that basically reduces the maximum rate from 37% to 29.6%. So when you compare the corporate rate of 21, you have to determine whether or not this 20% deduction applies, because you may be comparing, 21 plus the tax on distributions versus 29.6 versus 21 versus 37. Now, there's all sorts of phase outs and limits, and it depends on what kind of business you are. The way I look at it is you look at the taxpayer's taxable income. So here we're now looking at the individual partner or the individual shareholder or sole proprietor. And if his taxable income is, again, on a married joint return under 315, you don't need to worry about all these very complicated rules we're going to be going through in a minute. But there's many of these businesses where the taxable income exceeds that. And when you start exceeding 315 of taxable income, you have to sort of divide the world between specified service businesses and businesses that are not specified service businesses. And again, we relate back to 1202. Specified service businesses include law firms, medical firms, accounting firms, other kinds of professional firms. But for this purpose, engineers and architects are excluded from this limitation. There's a lot of provisions in this new law, and we'll cover some of them later, that favor people in the real estate industry, architects and engineers for the most part, to a great extent work in the real estate industry, and they're the beneficiaries of a number of provisions, and this is just one of them. So if you are a specified service business, the 20% deduction phases out entirely between $315,000 and $415,000. So if you have partners or shareholders who make more than $415,000, there's no 20% deduction. If you're 10% over 315, 10% of the 20% deduction goes away. There's all sorts of complicated calculations to determine that. But if you're a specified business, 315 and 415 for at least people filing married joint returns are the key figures divided into two if you're not filing a married joint return. If you are not a specified business, and this is the other half of the pass-through world, there's a limitation, and that limitation is tied to your W-2 wages. And so there's an alternative test that you can apply, whichever one of the alternative tests results in a greater deduction. So one of the alternatives is 50% of wages paid to the employees of the group, eligible to that individual. And there's all sorts of questions about what if you have special allocations and all sorts of things on your K-1 that, we don't have the answers to those at this point. But the other alternative is 25% of wages plus 2.5% of your unadjusted basis in qualified property. Again, something that I think would benefit people in the real estate business. So those are the tests that apply. It's really limited to the sort of taxable income from the group to ordinary income. You exclude capital gains and dividends. You can't boost up your taxable income by failing to pay reasonable compensation. So, but what that is a big question, because if you're dealing with, a businessman, whether, the guy makes $250 or, $1 million, one might argue both of those are reasonable. So while you have to live with the reasonable compensation requirement, you probably have a little bit of flexibility in doing some planning for individual businesses in that respect.
And John, if I could just comment on that reasonable comp issue, we've seen that issue for years with S corporations, where you take out a very low salary and take out the rest as a distribution to avoid the employment tax on that. So we're very familiar with arguing what's reasonable compensation. I will also point out that in the context of an S corporation, and I mention this in almost every speech I give, if you cut a deal with the IRS for an S corporation, it can be an interest-free adjustment if you have to concede some amount of tax if you structure it correctly. And I won't get into what that is, but just be aware of the fact that this issue I think is going to get bigger and bigger. It's already been big for the last few years, but there's some structuring that has to happen when there's a tax audit.
There's going to be a lot of planning and thinking about this deduction. Let's say you have a business that it's not a specified service business, it's a manufacturing company, and they have the real estate outside the business, owned by the owner of the business, and it's throwing off income at this point. Well, and it's a triple net lease. Is that a separate qualified business, or should the two be combined in order to increase 20% deduction? There's all sorts of thinking and maneuvering about combining or separating out related businesses that I think we don't have the answers to, but are going to be interesting going forward.
Yeah, this solution, I have a couple comments. Yeah, you wonder if the reasonable comp cases in the C Corp context are going to go away now. The ordinary income rate on bonuses is around 30% plus the FICA tax, and if you run the math on paying corporate tax and then paying a dividend, it's right around 40%. So those two often marry up. So if there is going to be reasonable comp cases, it might be related to these flow-throughs where they want you to pay more so you get less of a deduction, as you pointed out.
I think that's right, Lucian. I call them a reverse reasonable comp case, but I think that's where the action is going to be going forward.
Yeah. The rate differential now between capital gains and ordinary income is much narrower if this deduction applies. It used to be around 20%. Now it's down to maybe 10%, maybe 12% if you're including state taxes. So, again, in deals where you always try to maximize capital gain and avoid ordinary income, there's not as much pressure on that under these rules. My last comment is a lot of us are really struggling how to incorporate this into our agreements, like buy-sell agreements and operating agreements, as it relates to tax distributions. And normally you distribute at the highest rate applicable, but what does that mean in this context? Because of all these limitations, you might not know if it applies or how much of your income is going to be eligible for this benefit. So it's really hard to determine that rate. And a lot of times you're negotiating with your bank, and they'll only let you make tax distributions. So we're going to probably see a lot more negotiations, with banks and amongst partners on how to figure out what that rate is. Especially if you have C Corp partners in a partnership, their rate is potentially a lot lower than your individual partners. They're only at 21%. So they're probably taking a lot more cash off the table, potentially, than their non-corporate partners.
Yeah, also, one of the things that's to be determined is this whole concept that we've lived with for years, whereby when you're selling a business, typically, if you're going to sell, a buyer's going to buy assets, the buyer may pay you more for the assets than he will for the stock because of the basis step-up potential. But in the past, and sort of valuing that basis step-up value to the buyer, when you had a higher tax rate than what you're going to have going forward, assuming the buyer is a C corporation, you're probably going to get less of a gross up in your sales price because of the value of the step-up, because now it's worth less. Now, if you can write it off all right away, he may get the benefit sooner, but it's going to be at a lot lower rate. But if he's got, if it puts him in an NOL situation, he may be uncertain as to wanting to give you full credit for that right away because he may not get the whole full tax benefit right away.
Yeah, that's a great point. I agree. Okay, let's move on to partnerships. Leading up to the election, our last election, the one thing I thought for sure you would see no more of is long-term capital gain for carried interests. Even the president said he didn't like it. It seemed like on both sides of the aisle, neither party liked it. Well, guess what? Carried interest survived, although in a modified form. And when we say carried interest for this purpose under the new law, we're talking about a profits interest in a partnership that's generally given in exchange for investment or management services, okay? We're not talking about employees who are working in a business like a manufacturer who get an equity incentive like a profits interest for their services. This is really tied towards investment partnerships. And, you hear the terms hedge funds, private equity funds, real estate funds. It's those types of fund interests that are going to be subject to this. And essentially what the new law does is it creates a 3-year holding period for these carried interests. And any gains during those 3-year period in which you receive the interests that would otherwise be long-term capital gain, those are converted into short-term capital gain that are taxed at ordinary income rates. This does include real estate, so people putting together real estate deals, even if they're sort of one-off real estate transactions, if there's any type of profits interest in there for putting the deal together, or any type of fee waivers you'll often see that are structured as profits interest, those are going to potentially be subject to this 3-year holding transfers, or you transfer these interests within that 3-year period, in a transaction that might otherwise not be taxable, you actually accelerate the gain. You can trigger tax for transferring a carried interest to a related party if it's done within that 3-year period. Okay. One of the things that I think has been a long time coming and makes a lot of sense is the new law repeals what we call technical terminations. Under the old law, if you would transfer more than 50% of entity tax as a partnership during a 12-month period, you would trigger a technical termination. And the effect of that is you trigger a tax filing requirement, and the other negative effect is you'd oftentimes have to restart your depreciation. So if you had a building that was depreciated over 29 years and you only had 3 years left, if you accidentally tripped a technical termination, you'd take that 3 years of remaining basis and spread that out over 29 years. That doesn't apply anymore. And you don't have people who are going to fall into this late filing trap anymore and potentially be subject to penalties. So this is a good change. Now, there still are what I refer to as actual terminations. And so that occurs when you basically liquidate or wind up. But more commonly, it occurs when you go from having a multi-member LLC to having a single-member LLC. Okay, so those terminations are still out there. You need to think about those and make sure you're planning properly. A couple other brief items that I'll mention. Under old law, foreign taxes and charitable contributions were not taken into account when determining partnership basis for purposes of loss limitations. They now are clearly taken into account. And the IRS also changed the 754, 743 election rules to say that when you buy an interest in a partnership, if there's a substantial built-in loss, you may have to reduce the basis of partnership assets, even if you don't have a 754 election in place. Again, this is designed to prevent the seller from recognizing a loss and the buyer from recognizing the same loss in a transaction. 1031 exchanges, most people think about these as only applying to real estate, but technically they used to apply to everything that was a trade or business asset. Now, going forward, it's only real estate. So again, John mentioned a lot of benefits for real estate. This is one of them. Now, one thing we've seen is aircraft. A lot of times, aircraft will be written off. Aircraft does go down in value, but typically not as fast as the depreciation deductions, and people will exchange into aircraft. That's gone now, but some of that lost exchange benefit might be made up by the bonus depreciation rules, and there can still be a very significant sales tax benefit to doing trade-ins on aircraft. So that's something you definitely want to take a look at. Contributions to capital, and I know Mike has had a few cases on this issue, but under the old law, if you got a government grant and it was given to a corporation, including things like TIF proceeds or a forgivable loan, if that was done to a corporation, generally you could exclude that from income. You'd have to reduce the basis of your property, but you could oftentimes receive those government grants on a tax-favored basis. Now the new law is we're not going to or the IRS doesn't allow people to take advantage of that anymore unless you actually issue stock when you get this type of contribution to capital. So a lot of the planning we used to do with setting up S corporations to receive TIF funds and things like that, that's not going to work anymore. I mean, these grants are not going to be taxable. In my view, it requires a lot more planning now, and perhaps in some real estate projects, you can do more cost segregation studies, take advantage of the new bonus depreciation, and time your receipt of these government grants so you can use your depreciation to offset some of that income. There's also a grandfathering for any master development plans. We don't know exactly what that means yet, that were in place as of December 22nd. So that'll still be out there.
And Lucian, if I could just comment on this, yeah, we had a number of these cases where TIF money, happily we didn't plan these, TIF money rolled into an LLC, not into a corporation, and the IRS would take the position that said Section 118, which was drafted before the existence of the LLC, has the word contribution of capital to a corporation. You couldn't receive that as TIF money, and we resolved all of these cases. The IRS came out last year. The Large Business International Division of the IRS lists its campaigns, in other words, the items that they're going to go after hardcore, and that was on the list as late as last fall. So, it's funny how on one hand the IRS was gearing up to continue to go after these cases, and then Congress came along and solved the problem for them.
Yeah, and there were even some real high-profile cases going back to the, New Orleans.
Right.
Their arena got a big contribution from their local government, and the IRS aggressively went after it. And I understood they paid all the taxes associated.
Yeah, we were actively watching that case, the New Orleans Saints case, where after Hurricane Katrina, they got some money, and they were structured as an LLC. We had a number of cases at that time docketed in tax court on this very issue, and the taxpayer in that case, New Orleans Saints LLC, conceded the issue in full, so it was not beneficial to us.
See, Michael, I have seen cases where the money rolled into a related entity, which then loaned it to the partnership. Has the IRS gone after those situations?
They've issued some guidance, not liking it. Again, the problem for the IRS is now solved.
Yeah.
But yeah, that's how we would structure them. It would go into an S corporation, and I got some rumbling back and forth, and that's why in a lot of these cases we resolve them, because nobody wants to be the challenge case on that issue. But again, now Congress solved the problem for them. Now let's talk a little bit about entertainment expenses. This is going to be an interesting issue going forward. Section 274 is amended to say the general rule in 274A says that with respect to an activity which is generally considered to constitute entertainment, amusement, or recreation, you don't get a deduction for it. Now, 274E was not changed, and 274E has exceptions to that rule. If I pay for entertainment and I put it on your W-2, I can deduct it because it's a wage to my employee. And then there's also this exception that says business meetings of employees, stockholders, agents, or directors, meals for business meetings of employees, stockholders, or directors was not changed as well. So now we have the issue of, is it entertainment for a meal? Is it entertainment, or is it a business expense? A business within the definition of 274E5. So the general rule, and clearly what I think Congress was getting at, is all entertainment not deductible. But we find little exceptions there. And if you search the web on this issue, you see a lot of confusion on this. For example, Lucian and I go out and we golf. And we chop up the course pretty well, and we're with a client. That seems clearly to be client entertainment. On the other hand, Amy Barnes and I sit down with a client and we talk about the matter at hand, the business we're doing, and there's a meal in there. Is that a business expense or is that entertainment? We're going to argue it's a business expense, but there's certainly a gray area on this. The issue of what constitutes entertainment has come up in the past. We've fought this fight in the area of the personal use of an airplane. If you use an airplane and it's personal entertainment expense, it's treated in one manner. If it's personal non-entertainment, it's treated in the other manner. So we've had cases, for example, where our client would take their child to college in the private plane. Is that personal entertainment or not? I'll put it out to the group. My answer is, depends on the kid. Sometimes take them off to college is very entertaining. Other times it's not. But I think what you're going to see, and I'll just put this out to the group, I think you're going to see a dispute over, especially a meal. Was this meal entertainment, or was this part of the business meeting for employees, stockholders, agents, or directors?
To what extent do you think, Michael, it's going to put a premium on keeping good notes about what was discussed during the business meeting rather than just say, oh, we had a business meeting?
I think that's a good point. You look at 274 just in general to deduct meals and entertainment, and there's special rules under 274 that you have to have the place, the purpose, all that stuff. Now that's on steroids, if you will. You really almost got to keep, like you said, very good notes about that it was business and it wasn't entertainment. Now what it does do is it makes such stuff like luxury suites at sporting events at stuff like that, that seems clearly to be more in the category of entertainment and not in the category of business expenses. But I think we're going to see, that's going to be very interesting down the road.
Yeah, and my reaction to this was, are more companies going to start treating business entertainment similar to how they treat perhaps the reimbursement of club dues, for example? Club dues haven't been deductible for a very long time, and what a lot of companies do is they say, we'll reimburse you for your club dues, but we're going to include that on your W-2. You're going to have to pay tax on it personally, so that the cost of joining a club as an employee, where it's reimbursed, is really the tax. And so, I guess the question for a lot of people who do, a lot of entertaining, business entertaining, including lawyers, are they going to be less inclined to do so if they got to kick in individually, at least for the tax on a lot of this stuff?
And the answer is I don't know. For example, Rob Meisey, I'm looking at Rob, who belongs to numerous private clubs around the entire United States. Does minus on a W-2, I guess. But what will others do? I think they're all worthwhile.
Okay, let's look at a couple of the changes they made to tax-exempt organizations. One minor one, at least for a lot of the tax-exempt orgs that I work, is under old law, you could consolidate effectively all of your unrelated trades or businesses. So if you had some that were losing money and then some that were making money, you could consolidate it all and then only pay tax on the net amount. Now, under the new rule, each one has to stand on its own. And again, there's not a lot of clarity, on what constitutes a separate trade or business from this. And so you could have situations where in the aggregate, your unit activities are losing money, but you might still owe tax. Amy, you want to cover the next point?
Yep. So there's now a new 21% excise tax that's going to apply to certain compensation paid to executives. And what this really gets at is that historically there's been limitations on the ability to deduct compensation in excess of $1 million by public for-profit companies to certain of their key executives. Well, given that a nonprofit is tax exempt, that loss of deduction doesn't have the same impact. So in effect, this creates that result. So it's the nonprofit itself that pays the tax, not the individual. And it's on two things. One, to the extent compensation exceeds $1 million within the year. And then also with respect to severance. So now when you have severance payable to one of these covered individuals, you'll run a test. And to the extent that the severance payable is equal to or greater than 3 times the base amount, this 21% excess will apply over that. So it's very similar to the calculation we run on 282 parachute payments. Who's covered by this? The defined term is covered employees, so it's going to be the 5 highest paid individuals of the nonprofit. And as soon as an individual becomes subject to this rule, they're going to stay subject to this rule going forward. So it started applying in 2017, so anyone that was one of the 5 highest in 2017 will continue to be subject to it. So even if in 2020 you hire 3 more people that are now the new highest paid, it could cover up to 8 people at that point. There's a lot of press on this on coaches of large public universities, mostly because some of their salaries are so eye-opening that I think it catches people's attention. But where we've seen it a lot with our clients is actually large health service companies. So large health systems, some of their key executives will exceed this $1 million. Now, there is an exception which might benefit them. There's an exception for compensation paid to licensed medical professionals, or their work actually relating to providing medical services. So right now, you might see some of these executives at the large health systems just receive a set salary. Well, we may need to re-examine some of those employment agreements to see if we can allocate it between their administrative services and the actual professional services they're providing as a medical professional.
Maybe oftentimes you see college coaches will get compensation from maybe 3 or 4 different organizations. You might see an alumni group. You might see the school itself. You might see the foundation, maybe the sponsor. Is all that aggregated for purposes of the $1 million?
Related parties will be. So it will be to some extent. There may be some ability to have a party that's not aggregated, but you'll have to look at how that works.
Yeah,
Don't forget the slush fund, Lucia.
that's right. The last thing we'll mention on tax exempt organizations is only for certain private college and university endowments, they're now subject to a 1.4% excise tax on investment income. And essentially, this rule is always applied to private foundations, and now, Congress wants this to apply to only certain private college and university endowments.
So we just want to spend a little bit of time on changes to executive compensation. And you'll see our first bullet point could have gone as a whole speech on executive compensation if there had been changes to 409A turned into this one slide. So 409A did survive in its current form, even though there were proposals in both the initial House and Senate bill that would have drastically changed that. That did not go through. So the question is, what changes did go through? One, Code Section 162M, which disallows a deduction paid by a public company to covered employees that exceeds $1 million. That limitation has been pretty significantly expanded in a couple of respects. One, there had been a weird quirk in the law, and it was because the IRS referenced SEC disclosure requirements that actually pulled a chief financial officer out of the definition of a covered employee, so they weren't going to be subject to this limitation. Well, that's been corrected under this new tax law. So the covered employee is going to be the CEO, the CFO, and the three most highly compensated individuals. And again, as for when a covered employee, when you look at it, 2017 is the first year, so anyone that would have been a covered employee in that year. And then once you are a covered employee, you will continue to be a covered employee for years going forward. There's also been an expansion that a publicly held corporation for this purpose is expanded to include any company that's required to report with the SEC due to public debt. So you may have some private equity portfolio companies that could actually come within this rule due to public debt. Finally, probably the most significant one here is there has been an exclusion for performance-based compensation. So to the extent that amounts paid to these covered employees qualified as performance-based compensation, which could include stock options, stock appreciation rights, that exception no longer applies. And that there is one transition rule for that. So there is sort of a grandfathering exception to the extent there was a written binding contract as of November 2nd of 2017, and that contract not materially modified. You can continue to rely on that performance-based exception. It's not clear there, though, how broad that will be viewed, given the written binding contract element to it. Is the fact that the company had the ability to unilaterally amend the agreement to mean there's actually a written binding contract, or if the company had the discretion to reduce the amount, is there a legally binding right to that? So we're hoping that the IRS will issue more regulations on that point.
Amy, I've read that the general expectation is that companies will not abandon performance-based compensation, even if it is now not deductible, simply because of the alignment between the interest of the shareholders and the management.
I think that's fair. I think they'll continue to use it as an incentive. But that being said, given you no longer have to satisfy all the strict requirements under the code, I think it's still beneficial to probably review your contracts, because now you can provide more flexibility to the company.
Yeah, and the downside of losing the deduction is obviously offset by the much lower rate. I mean, again, you go back to, what's the tax on compensation? It's probably around 40% when you add FICA tax if you're in the highest bracket. And when you add the corporate rate and the dividend rate, it's probably around 40%. So effectively, you're almost treating it like a dividend, but you're losing the corporate deduction.
One other change, there is a limited ability to defer income on stock options and restricted stock units. Initially, your eyes may peek up at the ability to defer, but this is actually a pretty narrow exception. The reason being, it only applies to privately held companies and to the general employees. So it does not apply to the executive level or the highly compensated employees or a 1% shareholder. And for this to apply, the ability to defer, there has to be an equity compensation plan established by the company that grants either stock options or restricted stock units to at least 80% of the U.S. full-time employees. So it can be difficult to satisfy that, and it doesn't work with respect to our kind of one-off executive compensation arrangements we have. To the extent this does work, the individual can elect to defer tax 5 years after the date that it otherwise would have either the options exercised or the restricted stock unit settled. The election to defer is going to be similar to an 83B election, so kind of a similar format where there's no exact format set, but the regs refer to that 83B election.
Yeah, when you look at some of the requirements for this, my initial impression, Amy, was that this really, the only circumstance where you might see this happening is like a startup business where they don't have any money to pay anybody, so they pay them with, stock or options.
I think that's primarily where we'll see it. So there's probably a pretty narrow scope to this.
A number of questions have come in. Before we jump into the next section, which is international, I see that a number of questions have come in, and these are domestic related. Why don't we just address a few of these right now, and we can certainly follow up with you if we don't. The first one I see is the new net operating loss change apply only for businesses or for individuals as well? I think it applies to both. We put it in the business section, but I think the carryback of the net operating loss, at least until the law changes, is gone for now.
Right.
Lucian, was there one that you were going to address?
Yeah, I mean, one of the questions is, does the mortgage deduction apply in addition to the standard deduction? And the answer to that is clearly no. You're either itemizing and you take the mortgage deduction, or you get the standard deduction. And you take someone who maybe they own their house, they make some charitable contributions, and they pay state income taxes, right? $10,000 is all you can take for all of your state taxes, property taxes, sales tax, income tax, whatever all that adds up to. You're capped at $10,000, right? So if you're married, there's a spread there of $14,000, between $10,000 and $24,000 before it makes sense for you to itemize, right? So you could have $10,000 in mortgage interest, and you're still going to take the standard deduction, right? So you're not going to get any benefit or any incremental tax benefit from that mortgage. If you have a big mortgage, however, you'll get some benefit and you might itemize. Or if you have a significant mortgage and you make charitable contributions, then you might itemize as well. But if you take someone who may have paid off their mortgage, and all they have beyond state taxes are charitable contributions. Their first $14,000 of charitable contribution, they really get no incremental tax benefit from. So if you've heard a lot of comments about this might, reduce the incentive to give to charity, I mean, that's your situation. You got people, who don't have a big mortgage, getting no incremental tax benefit.
I've got one, a registered investment advisor earns income from fees charged to various entities. And then in addition to the normal management fees, there's a performance fee paid from time to time as these investment vehicles sell assets at a gain. And the question is, does that constitute part of qualified business income? And I don't have a definitive answer, but my reaction is, to the extent it is a fee for service, and that's the business you're in, is qualified business income. To the extent the business is investing in the entity itself, unless that investment is part of its regular business of investing, it's probably going to be excluded.
Yeah, here's another one that I thought was a good question. So let's assume you have, for example, a Wisconsin S corporation, and all the income from that S corporation flows through to the individual for both federal and state purposes. And the question is the state income tax that I'm paying on that flow-through income subject to the $10,000 limit? And the answer is yes. The way I read it, that's a state income tax. Now, if the S corp pays a property tax on its property, that's a situation that wouldn't be subject to the limit. So you wonder if in some cases, states might change the rule on some of this so that, maybe you make it an entity level tax, for example, for state purposes, so you can get a federal benefit from it. The other thing to think about is some states allow you to elect out of S-corp treatment for that state. Some states require a separate election to be taxed as an S-corp. You might think about maybe, electing out of S-corp treatment or not filing that election in that particular state.
With that being said, now we'll try to get back to any more questions that are out there. But why don't we transfer it over to Rob and Ben, and you can say a little bit about the international provisions of the new law.
Well, actually, we have a lot to say about the international provisions of the new law, Michael, because I think as a practical matter, the driving force behind the entire tax reform bill were the international matters and repatriation of income from abroad. A couple of themes seem to predominate when we're looking at the international provisions in the Act. The major one being, as I alluded to earlier, it seems like it seems basically that everything good in the international provisions is good for C corporations. Everything bad in the international provisions is bad for all taxpayers, including individuals and LLCs, partnerships, and S corporations. I view the best thing in the Act is for C corporations, and that's the participation exemption. The participation exemption puts us in line with just about every one of our foreign trading partners. The participation exemption is what I believe drove all these inversions we've been hearing about for the last 10 years. So let's look at how we repatriated money before, and we're talking in terms of a C corporation. We have, in my simple world, earnings and profits is merely income less foreign taxes. We have E&P of 80 because we paid a 20% rate in foreign country F. Before 2018, we had the deemed paid foreign tax credit regime. And let me say, I like to think of it as the draconian deemed paid foreign tax credit regime. Just like when you watch the Masters, they never win the green jacket, they win the coveted green jacket. It's the draconian deemed paid foreign tax credit regime. And in this situation, before 1980, even though you had 20% tax rate in foreign country F, your effective rate was going to be 35%. Why? Because in the United States, you got a free credit tax rate of 35. You receive that draconian deemed paid foreign tax credit of 20. You have to pay the residual tax of 15 to Uncle Sam. So U.S. companies operating abroad were always paying tax at basically an effective rate of what their U.S. the top rate in the United States was. On the other hand, other countries, when they did business abroad, would only pay, for example, that 20% floor tax. Any dividends brought back to the other country's home parent would be exempt from tax. Now we've come along with just about the rest of the developed world, and we have an exemption. We have an exemption from 2018 onwards, this participation exemption, where you just don't pay any tax in the United States. So now all of a sudden, the tax rate went down from 35%, not to the 21% new corporate rate, but 20%. So let's talk about some of, too far. Why did I go so far? Okay, here we are. Some of the requirements for the deemed paid or the participation exemption only applies to foreign dividends. And I'll say foreign source dividends. You can have situations where a foreign corporation paying a dividend has the trade or business in the United States, part of that dividend could be considered U.S. source. That applies if you have over 20, if the foreign corporation has over 25% of its income from U.S. sources. It only applies to the foreign source portion dividend. For our simple world, all these examples, it's all foreign source dividend. There's a holding period. You have to hold the foreign shares. The C Corp has to hold the foreign shares for 366 days during the period beginning 1 year before the ex-dividend date and 1 year after the ex-dividend date. The exemption is not available to hybrid dividends. What would be an example of a hybrid dividend? You create some type of instrument that's equity for U.S. purposes, that's for foreign purposes. So even though you're treated as receiving a dividend in the United States from a foreign country, creates a deduction abroad, no dice, no participation exemption. As I mentioned earlier, this is to replace our draconian deemed paid foreign tax credit regime. You do not get a credit for either deemed or, for that matter, any withholding taxes. I can imagine that there will be some tax planning done when you're operating in a foreign country, working with foreign tax professionals to try and minimize that amount of withholding taxes. That's not going to be creditable for U.S. tax purposes. Now, in the past, S corporations, LLCs, and individuals were now eligible for the deemed paid foreign tax credit. And oftentimes, we would check the box for a foreign corporation to convert uncreditable foreign corporate income taxes, such that we now have a disregarded entity and they're treated as being paid by the individual. There were no longer corporate taxes to get a direct foreign tax credit. I think that one strategy we're going to be looking at, if we're operating in a high tax foreign country, it's a practical matter. A lot of countries are now higher tax than us. It used to just be Japan and Italy, but now you can throw in a lot of different countries. You can throw in Sweden, you can throw in Germany, you can throw in France. So we're going to start exploring options with checking the box for a foreign entity. As I mentioned, C corporations get everything good. There is no participation exemption for flow-through entities or owners. So same tax here. Foreign sub has 100 of income, foreign tax of 20, E&P of 80. But it's not a C corporation owns foreign sub. It's a single member LLC that owns foreign sub. This occurred before 2018. They're going to pay tax in the United States of 16. No foreign tax credit. 16 because the qualified dividend, 16 in the U.S., 20 abroad, that's 36. What's going to happen in 20? Same thing. No difference. Not much of a break for non-C corporate owners of foreign subsidiaries. So, what's the potential strategy we're going to use to repatriate money? Let's go to the next slide. We're exploring ideas of contributing the foreign subsidiary to a C corporation. Once again, before we had a C corporation, we paid 20 of foreign tax and 16 of U.S. tax. After the C corp, we only have the 20 of foreign tax. That $80 dividend, assuming we have the appropriate holding period set by the appropriate holding period requirements, it's going to be exempting this tax. Now, there's some wise guy, I'm sure, in the audience who's thinking, oh, wait a minute, now you're stuck in a C corporation. Well, it was basically stuck in a C corporation abroad, but at least this way, you have it in the United States. You don't have it in the foreign country. So we have this participation exemption that starts in 2018. And theoretically, under the guise of wanting to clean out all these old E&P accounts, we have the deemed repatriation regime. However, as I mentioned, once again, everything good is for C corporations. The deemed repatriation regime applies for, notice the title of the slide, all U.S. owners, not just C corporations. It's all U.S. owners. And it's, what is the tax rate? The extent of cash and cash equivalents that you have E&P is 15.5%. All remaining E&P is taxed at 8%. This is for all U.S. owners. Corporations and individuals will pay tax at the same rates. Let's look at some of the details on this. Oh, before I go to that more detail, it's effective for the last tax year beginning before January 1st, 2018. So if you're an individual, most of your planning opportunities have passed. So let's talk about the numbers we're using to calculate. We need to know the accumulated E&P amount. We need to know cash and cash equivalents. But they're determined on different dates. The accumulated E&P amount is the greater amount on either November 2nd or December 31st of 27, November 2nd being the date that the House bill came out. When we determine the cumulative post-80 16P accumulating income amount, we don't consider effectively connected income or previously taxed income. Okay, so that's the E&P amount. We need to know cash or cash equivalents. It is the greater of either the amount on December 31st of 2017 or an average comprised of December 31st of 2015 and 2016, the greater of those two. What are cash and cash equivalents? Cash is cash. Foreign currency is cash. Receivables are a cash equivalent, and of course you can net accounts payable against those receivables. The only thing I've ever seen with respect to allowing use of anything for fair market value in the international provisions of this Act is marketable securities. We treat them as cash equivalents based on their fair market value. What does this apply to? It applies to specified foreign corporations, which includes controlled foreign corporations, CFCs if you will, and any foreign corporations with 10% C corporation shareholders. And I pose this question. If you're a 10% C corporation shareholder, you're the only U.S. owner, can you obtain that information that you need? My take is it isn't going to be necessarily an easy exercise. Now, what happens in later years when you actually receive a distribution of cash? Remember, this is a deemed repatriation. This was theoretically how they're going to pay for all of this cash act by nailing the earnings of Google, Amazon, Apple that are abroad. Remember, it does apply to everybody, even our clients here in the heart of America. But when it's ultimately distributed, it's treated as previously taxed income, that is not considered taxable income because it's previously taxed income. That is notice 2018-7. Now, those of you who've heard me speak before know that I get upset over what I call the ill ones, the idiots left loose with a pencil who write the regulations for the IRS. And if you look, not only do we have this Tax Act that came out at the end of 2017, we got a notice 2018-7. That is 21 pages long. So I pose this hypothetical, food for thought in your next cocktail party. If the notice is 21 pages long, how long will the regulations be? I think we're looking, Michael, for a new volume to my regulation.
I think you're right.
So, when is the deemed repatriation tax paid? Well, you can elect installments over 8 years, but there are trigger events such as sale of the foreign subsidiary, liquidation of the foreign subsidiary, sale of substantially all the assets. The one great thing for non-C corporations, what this is, S corporations can indefinitely defer their payment of the tax. You aren't going to pay any interest on the deferral, but there's a special statute of limitations for 6 years after each return is filed. So let's go through an example with a C corp owning a foreign sub. Foreign sub has $3 million of E&P and $1 million of cash. The cash gets taxed at 15.5% for 155. The remaining E&P of $2 million gets taxed at 8% for 160 of total tax of $315,000. You can take a foreign tax credit. You take a haircut of 55.7% on your cash equivalents and 77.1% on your non-cash or cash equivalents. But remember, it applies to everyone, including the individual who owns an LLC in Waukesha County that owns a foreign sub. They're going to include they're going to pay tax at $315,000. Now they're an LLC. They're not an S corporation. Can they defer tax indefinitely? No, they cannot. They got a raw deal. So, what are some of the strategies to try and help these people out? Well, Lucian and I have thought about it, and if you file a Form 2553 before the middle of March, we can elect for the LLC to be an S corporation. Now, Lucian, if I'm understanding correct, we can't do this for all LLCs.
That's correct. Not only do you have to file the form, but you also have to qualify as an S corp on the date you want to elect, and that oftentimes requires some changes to the statutory defaults in LLC agreements to qualify.
Yeah, I'm sure you're thinking about things like the single class of stock rule and the fact that everybody has to sign on, which may be difficult.
Right, but assuming that's not a problem, the strategy is to make it an S corporation effective December 31st, so you can defer indefinitely. Okay, so now let's move on to the policy of taxing intangibles in the United States. We have two regimes. One is to give a break for U.S.-based intangibles. One is to nail foreign-based intangibles. The funny thing is, neither of them deal with any definition of intangibles. They assume that any return above 10% of gross assets is income earned from intangibles. So we have two different regimes here. We have the deduction for foreign-derived intangible income. I consider that the carrot. Essentially, if you have foreign sales and services taxed at 13.125%. Then we have the global intangible low tax income, the GILTI tax. GILTI is charged. It's taxed as subpart F income at 10.5%. I like to think of this as the STID. What does the GILTI do? Well, this is the thing that bothers me about this. That title of the bill, Mike, I believe there is the word jobs in the title of the bill.
In the title of the bill, that's correct.
Right, but what it does is incentivize moving high basis manufacturing assets to foreign countries, which theoretically means jobs would go abroad. At the same time, discourages moving low basis intangibles to foreign countries. So that doesn't quite make sense what they're trying to do. Well, let's first start talking about the GILTI tax. Remember, both of these taxes, they assume a rate of earnings above a 10% return on assets is attributable to intangibles. Now, this is going to be taxed to all U.S. shareholders. Once again, though, the C corporations get a break. They get a 50% deduction. In this situation, we have, that should say U.S. parent, not U.S. sub, U.S. parent owns a CFC. The CFC has what they call 10 million of qualified business assets invested, 2 million in net income, 200 grand of foreign taxes. What is the GILTI? That doesn't get old. It's net income minus 10% of QBAI. What's the net income here? 2 million minus 10% of 10 million. We have the GILTI of, oops, this is floating in. We have GILTI of 1 million. You can also get a foreign tax credit, although foreign tax credit is only 80% of the taxes paid that year, although you have to gross it up by your income by the entire amount of foreign tax credits. Let's talk about the deduction for foreign-derived intangible income. This assumes that U.S. company has intangibles because the way they're defining intangible income above that 10% return. Very complicated code section, chock full of many definitions, but basically, once again, you get a deduction to the extent that that intangible income, that return above 10%, is attributable to foreign sales and foreign services. So here with our facts, assuming net income and 500 grand of foreign sales and foreign services, we're going to get a deduction of $93,750. So when you do the math, that comes out to an effective rate of 13.125% on exports of foreign services. These exports are a little broader defined than the export for purposes of NIC, which Ben will talk about in a moment. What I think that we're going to have to start doing is we're going to have to start thinking about our supply chain management systems, because we don't want to create royalty income, we want to create sales and services income. So Ben, why don't you talk to us about IC Disc?
All right, so IC Disc survived under the new law, and what we use IC Disc for are to convert ordinary income received from sales to foreign unrelated parties into qualified dividend income. And here we've got an example just to kind of walk you through how IC Discs work. So we've got an S corporation with export income, and the S corporation pays a portion of this income to the IC Disc as a commission, and this commission is deductible to the corporation. The IC Disc will then pay that commission as a qualified dividend to its shareholders, and those shareholders will pay tax on that qualified dividend at a 20% rate. The S corporation will then pay taxes, or its shareholders will pay taxes on the remaining income at their individual rates. So under this structure had tax benefits both under previous law and under the new law. Another point to note is under the new law, we have a new concept we're calling a supercharged IC Disc. And what we do here is we take advantage of the reduced foreign derived intangible income tax rate on C corporations, which Rob mentioned earlier is an effective tax rate of 13.125%. So here we still, the C corp will still pay the commission to the IC Disc, which will then pay a qualified dividend to the shareholders. But then you look to the C corp, again, pays 13.125% tax on its remaining income, and then will distribute income up to its shareholders, which they'll pay at a 20% qualified dividend rate. So the benefit here is we can essentially, if the facts are right, we can choose a double tax over a single level tax. And one important point to note is that this only works if the U.S. shareholder, their individual tax rate is high enough. So for instance, if it's high enough. So for instance, if they're paying tax at a 37% rate, there would be a benefit under the supercharged IC Disc structure. If they're paying tax, let's say a 29.6% rate, there would not be a benefit to using this structure over a classic IC Disc.
Okay, now I want to talk.
Can I ask a question about IC Disc?
Lay it out.
If you have an S corp with an IC Disc sub, and you're thinking of revoking your S election, should you distribute out the IC Disc to the shareholders or wind it down and create a new IC Disc before you get rid of your S corporation election?
I'd wind it down. The structure of a C corp owning an IC Disc just doesn't work because there's no dividends received deduction for a dividend received from an IC Disc by a C corp from an IC Disc. So you want to get rid of the IC Disc, liquidate it, and then you form a brother sister for the C corp. Okay, I want to talk about the issue that nobody is talking about, the foreign tax credit. This is a basic premise of U.S. credit law. The credit is limited by U.S. tax on foreign source income. Foreign source income is not determined generally by whether it's subject to tax in a foreign country, but under Code Sections 861 to 865. The thing that seems to hurt our clients here in the Midwest is the new rule on the sourcing of manufactured inventory. Previously, it was sourced under a 50-50 rule. Half would be sourced by where manufactured, presumably the United States, and half would be sourced by where title passes. If you did it right, you had title pass abroad, so you have 50 U.S. source and 50 foreign source. The new rule says it is all U.S. source. Because it's all U.S. source, there's no foreign tax credit limit. And what is the foreign tax credit? The bagel. You don't get it. You get the donut. No foreign tax credits at all. So you take our classic machine shop in Waukesha County that's organized as an S corp. They pay taxes of 20 abroad on 100 of income. Before 2018, they would get a credit of that 20. They'd have a pre-credit U.S. tax of 40. They subtract a credit of 20. Ultimately, their total tax is 40. 20 to the U.S., 20 to a foreign country. Now let's look at the scenario on the right. And we're assuming they're getting the benefit of the 20% 29.6% because I'm mathematically challenged. We're using 30%. They pay foreign income tax of 20. What's their credit? Zip. They pay 30 to the U.S., 20 to the foreign government. They now pay 50 of tax. I don't understand why nobody is striking about this. This hurts our clients here in the Midwest more than anything else. Remember, we used to check the box so we can get direct foreign tax rates, and you might notice the numbers on the left and the right are the same as the previous slide. What do I think we're going to have to start doing? We're going to have to start looking at rechecking foreign disregarded entities as foreign corporations. We're going to use transfer pricing principles to minimize the amount of income tax that foreign sub is going to be subject to. And then we're going to maybe even contribute the S Corp to a C corporation. So Ben, can you talk a little about the new baskets?
All right, so with the foreign tax credit, we apply it separately to different categories of income, and we refer to these as baskets. So this basket concept is designed to prevent averaging low tax income in one category with high tax income in another category, which could overstate the foreign tax credit. So prior to the new act, we had two different baskets. We had the passive basket and the general basket. So the passive income basket included dividends, interest, rents, and royalties. And the general income basket included all the exceptions to the passive basket. And with the new act, we now have two new baskets. The first new basket is a basket for guilty income, which Rob discussed earlier, and this is global intangible low tax income. And with guilty income, I'll note that it could also be passive income, in which case the passive income basket would have priority over the guilty basket. Another point to note about the guilty basket is that unlike the other baskets, carry back and carry forward is not allowed. So there's a 1-year carry back and 10-year carry forward for excess foreign tax credits in the other baskets, but not for the guilty basket. But also note our other new basket, which is the foreign branch income basket. And the income included here is income from qualified business units, which we also refer to as QBUs. And QBUs are defined as a separate trade or business of the taxpayer with separate books and records. And now turning to the next slide, we'll go over a brief example of the different types of income for the different baskets. So here we've got USCO that earns income from 4 different sources abroad. And over on the left, we've got interest from country F banks subject to 25% withholding. And although interest is passive, the high withholding tax is greater than the US rate. So this income is excluded from the passive basket and therefore goes in the general basket. Next, we have a Canadian sales office, which we'll assume qualifies as QBU with a separate trade and business and separate books and records. So this income will go in the foreign branch income basket. Next, we've got Germanco GmbH with a 20% return on assets, which will go in the guilty basket. And going back to the guilty rules, the guilty tax is based on earnings above 10% of return on gross assets. So again, we will have some guilty income in this scenario. And finally, over on the right, we've got interest from a UK bank subject to 0% withholding. And this 0% withholding is due to a treaty with the UK. And because it is subject to 0% withholding, it will go in the passive basket without an exception to kick it out.
Okay, now we're going to quickly move to the inbound rules. We're going to start off with base erosion payments. On slide 55, right? Classic situation, U.S. foreign parent strips income out of the United States through royalties, service fees, and interest. So, as a result, the Act came up with the base erosion and anti-abuse tax, the BEAT tax. That tax is at 5%. It acts as essentially an alternative minimum tax, because what you're going to do is compute tax at 5% of income without any types of, without the payments for royalties, service fees, and interest, and see to the extent that exceeds the regular corporate tax rate. In this example, we had net income of 20, resulting in corporate tax of 21% of 4.2, but without that outrageously high royalty of $250, they'd have $270 million of modified tax for 13.5. They would pay the BEAT tax of 9.5%. million. It's going to increase to 10% in 2019 and 12.5% a few years later. This only applies to big companies. You have to have, as a starting point, you have to have average gross receipts over the prior 3 years of $500 million. There's going to be additional reporting. I'm not sure whether they're going to increase the Form 5472 or come out with another form. I want to talk about the new rules for non-deductibility of interest. We used to have Code Section 163J, and we still do have 163J. Old 163J had this old 5-factor formula. Start off with a debt-to-equity ratio of greater than 1.5 to 1. In this hypo, we had 2 to 1. I can't tell you how much my partners in the corporate department here just wanted to do anything to avoid having a debt-to-equity ratio above 1.5 to 1. But there were other aspects to it. Now, we have a new provision for non-deductibility of interest in new Section 163J. You cannot deduct business interest expense that's greater than 30% of adjusted tax income. Adjusted tax income is only mentioned in Section 163J of the Code. It is not mentioned anywhere else. What's defined to be similar to EBITDA is going to start being the definition similar to EBIT in 2022. So if you look back in the previous page, we had net business interest expense of 20 and EBITDA of 15. So we have a situation where we can't deduct $15.5 million of interest. Now there's some size limits or size minimums before you're subject to this, not as much as the BEAT tax. It's $25 million over the prior 3 years, not $500 million. Okay, we have one more thing we're going to talk about, choice of entity in the United States. Essentially, when you have a foreign corporation coming to the United States, the ongoing operations of investing either a C corporation or an LLC are identical. Both pay the corporate income tax, and there's going to be a secondary level tax, either withholding tax on dividends or a branch profits tax, and that's an after-tax tax on earnings of the LLC. But previously we had recommended being a C corporation because if you're an LLC, it's treated as if you're selling a share of each of the individual assets and you're subject to tax in that case. The sale of a C corporation share by a foreign seller are not going to be subject to U.S. tax. That sort of got turned on its head this year. We had a case in the summer that said, hey, the IRS's position that sale of a partnership interest is treated as a sale of the assets doesn't apply. That was the summer in the Grecian magnetite mining case. However, the Act reinstates the service position in the old ruling and says that the foreign sale of the U.S. partnership interest is essentially a sale of each of the individual assets that is subject to U.S. tax. They went one further, though, than 91-32. They said that the purchaser of any partnership interest is going to have to acquire a certificate of non-foreign status from the seller or else incur 10% withholding. Now, this is effective for any sales after December 22nd. I wonder how many people have bought interest in a partnership or an LLC taxed as a partnership and not withheld nor obtained a certificate of non-foreign status. I think there should be some big issues here. Mike, that's it for international.
Thank you. Appreciate it, Rob. This last slide here is just, it's hard to read. It shows IRS has historic funding. The point is, the last time the IRS got a big infusion of capital was 1987, right after the 86 Tax Act. And the IRS publishes this on their website, of course, showing that revenue goes up when they get a bunch of money. So we'll see what happens.
Well, that's when they hired me.
There you go. But there's talk that they may get some money, but there's talk they may not. The last issue, a couple questions came in. One of them is about the research credit. Did it survive the law? And I think the answer is yes, it did. It's alive and well. I think the reason people have asked that question, there was an article in the Wall Street Journal in about November saying that the proposed tax law might be the end or damage the ability to take the Section 41 research tax credit. That was because of the corporate AMT, and if that sometimes the corporate AMT would put you in a position where you had to carry your research credit forward. You couldn't use it. With the corporate AMT gone, the research credit is alive and well, although as Ben and Amy and I know, since we just tried a research tax credit case in early December and are briefing it right now, IRS is not a fan of that, even though Congress encourages it. So with that being said, I think we are right at 100 minutes, which is enough time for 2 hours of CLE or CPE. But I'll just say to the group, any concluding comments before we wrap it up?
This is Rob, and my concern is look out for how long the regulations will be.
Absolutely agreed.
This is John, and I would say don't rush into becoming a C corporation without really thinking through all the possibilities for the future.
And then I'll just, Lucian, anything or anyone else? Amy? I'll just say thanks again. This is the first review of this law. There's going to be some regs, as Rob alludes to, coming out, I expect, and a lot of notices and a lot of confusion. Please don't put that up. And that's the whole picture, folks. You ought to see what it is now. But anyway, thanks for joining today. I appreciate it, as does the group. And have a nice afternoon.
You can leave it there.
That's the whole picture.